Hi, and welcome to Random Rogers Big Picture for the week of December 23rd. Christmas time is almost here. A lot of things to get to today, so I'm just going to go short on each one of these things. First, notice in the comments on Friday, maybe it was just one person, I'm not sure, but there seemed to be a tone with regard to closed-end funds, kind of a willingness to take a lot of risk trying to game the various discounts that some of these funds have, and trying to capitalize on them. And if you care about my opinion on the idea, you can read it on the post with a picture of Bobby Petrino. So I won't repeat myself there, but it's just kind of interesting to see, or to ask, are people willing to take more risk? Is that what is going on? There's, if you watch TV, you get all sorts of negative sentiment, all sorts of positive sentiment. We don't see a recession. A recession's already started, depending on who you... Bill Gross, a recession's already started. Other people know it hasn't. Is there a willingness to take risk? If there is, how great is that willingness? And, how can we use that as a forward-looking indicator for the next few months? Don't know the answers. It's just kind of an interesting tone that I think I picked up in the comments. It either matters or it doesn't. I want to add a little bit of color to the one swap I did during the week for clients. I sold out of Barclays and swapped it into a bank from Chile. So did a couple of things there. One, the UK looks like it is going to be headed for a slowdown. And while I don't want to necessarily be out of the country, and I'm not, it probably made sense to lighten up in case that turns out to be correct. We'll just see what happens, but if you read some of the commentary out there about what the MPC is going through, some of the economic data, the extent to which they're sensitive to their own housing issues, on and on and on, it's a compelling case. And so I've got one left in the UK for just about everyone. I've got one consumer stock. A lot of people have one of the big global miners, which, maybe this turns out to be wrong, I'm not sure, but I don't view that as a proxy for the UK. This stock is also listed in the US. It's listed in Australia and South Africa. But we'll see what happens. Also, a few people own some very short-term UK 2-year Treasury notes. And I wanted to increase into Chile. If you look at some of the growth numbers expected, how little relative to all of their exports that they send to the U.S., they're really not that reliant on what happens to the U.S. The big macro of constant demand for their stocks through their public pension system, plus it had backed off a little bit of late. We'll see. We'll see what happens. So obviously in doing that, I increase emerging market exposure a little bit. However, I don't think it's a dramatic increase. And further, it's not relative to emerging market. Chile is not that volatile as places like Brazil or some of the other hot potatoes that are out there. So, but we'll see. It'll either pan out exactly as hoped for, or it won't. Right out of the chute, looks good, which of course means absolutely nothing. If your time horizon on making a big swap is 48 hours, this is probably the wrong site for you. Anyway, talking a little bit about emerging markets. So I did increase exposure. I'm going to say not in a meaningful way, but did do it nonetheless. And I want to talk a little bit about people, and this maybe ties in with the risk-taking that some people are willing to take in going real heavy in emerging exposure. I'll get to this in a second, but I looked at the video with last year's predictions in it, and one prediction that was wrong, and there were several, was that emerging markets might slow down a little bit. I believe I said that they would probably lag a little, nothing dramatic, nothing catastrophic, but that they would lag, and that I had lightened up some, did lighten up some. What I held on to had a pretty good year, but we had, if you look at the broad-based products, they're all up in the 30s percentage points. So if you're not a stock picker and you had one of those broad-based emerging market funds, and you're not a country picker, those did pretty well. 30+% in a year, I would say, is an awesome return. So in terms of weighting of emerging markets, if you had a 5% weight to emerging markets, something like EEM, which I don't use, and you're up close to 30%, you're adding from just that one 5% allocation, you're adding something like, if my math is right, about 170 or 175 basis points to the overall portfolio. So if you think about the equity portion only, and with the S&P 500 up, I think it's not quite 5% based on Friday's close. Let's just call it 5% because that's easy. If it's up 5% and you're up either, let's say, anywhere from a range of 3 to 7%, so plus or minus 2 percentage points, is nothing wrong with that. If that's where you are and you got 175 basis points just from a 5% allocation to emerging markets, and then you think about maybe you got another, and let's lowball here, let's say 200 basis points from dividends, think about how little risk you need to take with the rest of the portfolio, or maybe put another way, how little work the rest of the portfolio needs to do. To that point about how little it needs to do, think about some of the stuff I've kind of been talking about lately is some of the absolute return stuff. One thing I don't think I've ever disclosed is I've got a health savings account, and that money is probably, relative to what's invested, probably I invest that the most conservatively. I figure, something would have to really go wrong for me to tap that for some sort of health issue. But if that were to, long story short, I keep that in stuff that doesn't move around a lot. One thing I bought a while ago, and I don't think I ever disclosed it, was this Ridex Managed Futures thing. I bought it in the middle of September at 25, I think 15, something like that, in the teens, 25 and something teen cents. It closed Thursday, I didn't get Friday's number yet, at 26.37. If you look at a chart of it, and I've only had it for 3 months, nothing just doesn't hop around. It just inches around, and it's just moved up. It's up about $1.20, give or take, in the 3 months plus that I've owned it, which for a $25 fund, not too shabby. Point being that I think more and more you're going to be able to allocate to absolute things or things that have nothing to do with the stock market that can give an equity-like return and hold in there pretty well. This thing has done pretty well through some of the dips, this Ridex thing I'm talking about. Not that you should buy that, but the point being there's a long list of them. I'm more intrigued by infrastructure. I just wrote something on Friday about it's IGF is the ticker on thestreet.com. Take a look at the holdings there. There's some interesting stuff there that I've already started to study a little bit of. I would suggest you do the same. No harm in studying some interesting components within the fund that make a lot of sense. I think one thing that I mentioned in the article about IGF is no matter what's going on in our economy here, a slowdown in the U.S. isn't going to make the air and water in China any cleaner, or any dirtier for that matter. Point being, fundamentally, there isn't much of a link. Price-wise, there could be. If we do have a bear market, and I think we're in one, but if we do have one, yeah, those stocks could go down just as much. But you are, in exploring those types of ideas, you do own something that is not fundamentally connected. At least I don't believe that it is. Let's see, and looks like I'm out of time. I'll have to do a write-up on the last point about some of the predictions I made for 2007. Quite a few were right, quite a few were wrong, and a couple of them were sort of right, but not that right. All right, have a good weekend.